Hello, everybody, and welcome to the Tortoise channel. Welcome. If you are new here, welcome. And if you are not, thank you so much for the support. As always, I keep saying the same thing, but I can't stress enough how much I appreciate all the comments, all the feedback that you guys have been sharing. That tells me that this channel has legs. And sure enough, I intend to continue to put out as much content as I possibly can. I know that many of you guys are Portuguese people. Kudos to you because you have been big supporters of the channel as well, and hopefully we'll continue to find value. Okay, that's what this is all about. Right, guys, today's video is on software companies, and you would have to be living under a rock not to notice the massive selling pressure that the whole sector has been facing due to AI fears, right? There is this pervasive fears. There's this pervasive fear of AI disruption, and we don't know what companies are at risk of being disintermediated. And so, in today's video, I will do my very best to break it all down to you. Okay, so we cannot treat, not all software is created equal. That's one thing. And number two, while AI will for sure be very disruptive, and in fact, it's already being disruptive. I mean, we don't really know what's going to happen to some of these companies, okay? Because some of them are quite ingrained already in the economy, not only in the economy, but at a company level. They are well rooted in companies' infrastructure, and so the idea of switching can cause a lot of problems as well. And so I will do my best as always to just unpack everything for you guys to understand. Just to give you some context as well, I worked as a software engineer for about 6 years, right? So I do understand something about this space, even though, right, when we talk about software, I mean, new tools and new technologies are always being invented, which means that you always need to upskill, otherwise you will just become outdated alongside all these technologies. Okay, right. So I read quite a bit on this topic, right? Just to try to understand exactly what the heck is going on and whether there might be opportunities. As always, I put everything in a document which I will share with people in our communities, WhatsApp, and also Skool. If you haven't yet, please consider joining those groups. They are free. The way I make money is via coaching. Okay, in coaching, of course, I mean, our community has been growing substantially, and which I really love to see because I'm quite passionate about the markets and investing. And ultimately, coaching is only for those of you who actually want to speed things up and want to achieve better than average returns, right? And feel that accountability is going to be essential as well. But we can talk about that if you guys want on a separate video, right? So let's talk business here. Okay, so starting with our PDF, where is the PDF? Right here. Okay, so software sell-off and AI disintermediation fears, a framework for long-term investors. Okay, so why are software stocks getting clobbered? Over the past year, software companies have broadly underperformed as investors worry that advances in AI could disintermediate traditional SaaS models. For those of you who don't know what SaaS means, software as a service. The fear is simple but powerful. If AI can generate code, automate workflows, and replace entire software layers, do we still need many SaaS products? This narrative has not spared anyone, from large horizontal platforms like Salesforce, okay, to Adobe, ServiceNow, to vertical software specialists and aggregators like Constellation Software. As a result, valuations across the space have compressed, creating both real risks and potentially mispriced opportunities. This document breaks down what horizontal and vertical software companies are. So for those of you who are asking what the heck does that mean, this video will cover it all. How they fundamentally differ, where disruption is legitimate, and where those fears may be overblown. You know, it's it's almost unbelievable. And I can't tell you how many people told me that so for Constellation Software is probably one of the most beloved stocks among quality investors. And and you know, and I know quite a few of them. And the amount of so the number of people who have told me over the last many months that there is no way Constellation Software is going to collapse 50% or 60%. I mean, you actually wouldn't believe it. And this is what I try to preach on this channel, guys. Don't pay fair value, what they call fair value for a company. I mean, look, if you pay fair value for a company and if the company continues to be amazing over the next 10 or 15 years, you are still going to get a good return on your investment. And there are many studies that show you that, okay? But the problem is that you are not accounting for the uncertainties, what Charlie Munger called the vicissitudes of life. And this is what we are seeing right now in real time with Constellation Software, a stock that hasn't collapsed 50%, there hasn't been this cheap relative to its value in about 20 years. Okay, I kid you not. And the point here is that even great companies go through periods of uncertainty, and this is when we attack as Tortoise investors. We wait, we lurk in the bushes, we wait for the right opportunity to pull the trigger, and then, provided the story has not changed, boom, we buy. Okay, and this sets up will set us up nicely for massive outperformance over time. So I know this is not going to be a video on Constellation Software, right? But you know, the stock now from the all-time highs to where it's trading right now, this thing is down 54%, give or take. 54%. You see? So if you bought the company around, I don't know, I mean, probably, I don't know, 4,000 plus, you are now significantly underwater in hoping and praying for the stock to go back up. And now you are probably under a lot of stress because we don't know, right? Because the stock had a premium price on it, right? And now we don't know how much of this AI story is actually going to be is actually going to materialize. Right? How many of the we don't know how these fears are going to impact the company. Right? This is what I'm trying to say. Okay, so let's go back to our document right here. Horizontal. First of all let's discuss, right? Let's talk about the difference between horizontal software companies and vertical software companies. You have to understand this difference before we can start delving deeper into each of these companies. Okay. So horizontal software companies, what are they? Horizontal software companies provide solutions that can be adopted across many industries, geographies, and use cases. Their products are designed to be flexible, configurable, and broadly applicable. This is very important here. Broadly applicable. Why do I think this is very important? Because in my humble opinion, right, I think these are the basket of companies that are more exposed to AI disruption. Okay, so examples include Salesforce, Adobe, Workday, ServiceNow, HubSpot, all of which are getting absolutely crushed. What are some of the key characteristics of this market? Very large TAM, which means total addressable market, right? Millions of potential customers across sectors. So the thing is, because their software is applicable across industries and sectors, what happens is it's easier for them to scale that business as well, right? Right, because it's like they achieve a lot of operating leverage because they can spread those costs out over a large user base as they grow, and then once the software is built, right, the costs that it takes to actually maintain it and get new customers are minimal, right? So they manage to grow pretty fast and achieve that operating leverage that many of us like, for sure. Okay, so very large total addressable market, right? Millions of potential customers across sectors, growth driven, emphasis on acquiring new customers, high sales and marketing spend. This is important. right? Often 30 to 35% of revenue, high sales and marketing spend. Where did I get this information from? I got it from this great article that was put out by Main Capital Partners. Okay, so I was reading the article this afternoon, and here they break down vertical software companies, hidden gems in niches, in the horizontal versus vertical software companies, difference in revenue, in growth and profitability. And then they show you a very nice table here that we will refer to in a bit. Okay, so let's crack on. Global competition, competing with other well-funded platforms. Complex products must support many workflows and edge cases. So, what are the strengths here? Strong brand reputation. That's true, right? We all know some of these brands, if not all of them. Uh, Deep ecosystems and integrations. I mean, this is completely true. And I know that because, as I told you, I worked as a software engineer. And the matter of fact is, and even some of my clients, for example, that are working at Salesforce, they tell me when the CRM, so Salesforce, what happens is they are so embedded in some certain companies' infrastructure, right? So the software is so ingrained that if it stops functioning, it's like the whole business stops. All right. So this goes to show how powerful some of these companies can be, right? So it's you need them. It's not that you don't need them. So it's not an option. Once you have their software, switching costs is quite high because because of all the things that we've already covered. All right. So high switching costs at scale. But the structural weaknesses include slower path to profitability, feature bloat over time, and greater exposure to technology shifts. Why? What does that mean? Slower path to profitability. If you are building a successful software company, okay, what you will find is that the costs. So the costs that will be so initially it will cost you a lot of money to build out all the software. All right. So that is going to cost you a lot of money. And so in that sense, it will take a while for the company to achieve profitability because they are still building the software, which is expensive. However, as I mentioned, once they achieve once the software is built, then the costs to maintain it are actually minimal, right? And this is where operating leverage kicks in. And that's, for example, you will see with Salesforce that operating leverage has been going up pretty awesome over the last few years. Okay, awesome. So let's continue. Feature bloat over time, greater exposure to technology shifts. This is important. Greater exposure to technology shifts. Now, let's talk about vertical software companies, depth over breadth. This is what I like, as you will see, depth over breadth. What are they? Vertical software companies focus on specific professions and industries, combining deep domain expertise with tailored software solutions. Examples of end markets, for example, look, accountants, lawyers, nurses and healthcare providers, teachers in schools, architects and engineers. Okay, so for example, they don't build softwares that accommodate all of these end markets. That's the advantage. They are very niche, so they build software that can only be used by accountants, only be used by lawyers. Okay, and what that does is it requires in-depth knowledge of the end market, okay, which creates very high switching costs as well. So I love that. Okay, notable players, Constellation Software is not a pure player. What they do, they acquire vertical software businesses. So they are what we call a serial acquirer. All right. So why do they exist? Founders of vertical software companies often come from the industry they serve. The software is built around industry specific workflows, regulatory requirements, embedded processes that generic tools simply cannot easily replicate. Okay? Generic tools, in other words, so like that generic software, right, cannot easily replicate. This is very, very important. So, what are the main characteristics? smaller total addressable market per product. Makes sense, right? Because they don't serve everyone, right? So it's not again, we are the depth plays so we are prioritizing depth over breadth. High customer stickiness, right? Once they know the software, they understand its switching costs are very high. Lower sales and marketing spend, look at that, only about 17% of revenue. Again, I got that from the report. Look, targeted marketing and sales efforts, about 17% sales and marketing, okay? Revenue ratio compared to 34% for horizontal vendors, okay? In addition, what this study also found is that in our latest study, the market intelligence team of Main Capital sampled American and Western European publicly listed enterprise software companies and compared over 100 horizontal players with over 100 vertical software vendors. What did we find? Vertical software company players, so vertical software companies are more profitable than horizontal software players. Look at that. Look at the difference. 15% versus 6% median EBITDA margin. Okay? For those of you who don't know what EBITDA means, this is earnings before interest, tax, depreciation, and amortization. Okay? Awesome. So let's continue right here. Here we go. Higher profitability often operate quietly under the radar, right? In fact, many of you guys know some, if not all, of these horizontal software companies. You just didn't know they were horizontal software companies. But if I tell you about some operators in the vertical software market, like, for example, Topica, SI, VTech, I mean, you probably won't recognize any of them, right? Exactly. So why they exist? We discussed that. Often operate quite under the radar. Now, horizontal versus vertical economics comparison. We already discussed that. Based on studies of publicly listed US and European software companies, this is what they found, right? Revenue growth is slightly higher for horizontal software, slightly higher, not significantly, right? But the EBITDA margin is, look at that, comparatively way lower. Sales and marketing percentage of revenue, look at that, 34% against 17%. Okay, and valuation is actually similar across both sections. So the key insight here is that despite very different business models, valuation multiples have historically been similar, which suggests factors like revenue predictability and market stability, competitive positioning, management quality matter more than whether a company is horizontal or vertical. Okay? So, where AI fears may be legitimate, in my opinion, and based on my research. AI does pose real risks in parts of the software stack. Commodity features, for example, simple dashboards, basic reporting, standard workflow automation, these can all increasingly be replicated by AI copilots or agents. So that's it. Horizontal overlap risk. So horizontal platforms are more exposed to AI native startups, large tech companies embedding AI directly into operating systems, and customers consolidating tools. And let's think about this for a second, because let's think about this for a second. What do you think is which part of these companies do you think is at major risk of being disrupted by AI? A company whose software can be used in different industries, right? So is broader, right? Is less. How can I say? Is less specific, right? If it's less specific, it stands to reason that it can be more subject to disruption compared to a company that builds very niche software that helps a particular type of business. Okay, so yeah. So if I were to invest in one of these spaces, for sure I would prefer to invest in the vertical software market every single day. Right? This is what I'm trying to convey here. Now, pricing pressure. If AI boosts productivity, customers may question, why am I paying per seat for software that AI can largely automate? So, where AI fears are likely overblown, vertical software is harder to disrupt. Harder to disrupt. AI struggles with deep regulatory nuance. Think about that. Do you think the rules, the regulations are the same for accountants than they are for salespeople? Of course not. So these the software that is built for these niche markets is very specific, as I mentioned, right? It requires deep regulatory expertise. So in hence, it's more difficult to being disrupted. So industry-specific exceptions, mission-critical workflows. Replacing a vertical SaaS product is not just about writing code, it requires years of domain knowledge. Switching costs are underestimated. In vertical software, software is embedded in daily operations. Data migration is so painful. Training costs are so high. AI may enhance these systems, not replace them. AI is an enabler, thus not a killer. For many software companies, AI can improve customer retention, increase ARPU through premium features, right? Lower internal costs. In fact, so this means average revenue per user. Okay, sorry, forgot to mention that. In this sense, AI becomes a margin expansion tool, not an existential threat. So, why does this matter for investors? The current market narrative is treating software as they are is treating software as a homogeneous group exposed to AI risk. That is indeed a real mistake. Potential opportunity: high quality software companies, strong cash flows because they typically operate. They have a capital light structure, right? Deep customer lock-in. Temporary multiple compression driven by fear, not fundamentals. And this is very important. Why is this so interesting? Because, guys, these companies that are in the software space are hugely profitable. Certainly the most important names are very profitable. So exactly because they operate very capital light business models, right? And so it's not, they usually in normal conditions will command a premium because the cash flows are more predictable. So the fact that the whole industry is under a lot of pressure, this can create many opportunities for us long-term investors because of this, right, mispricing, right? So key takeaway: horizontal software faces more visible AI risk, but also has the scale to adapt. Vertical software combines niche focus with high profitability and resilience. AI will reshape software, but not erase it. All right, fantastic. Now, this is one thing that I want to that I would like to recommend. Right, so just um, you can look it up yourself, and you can see, for example, this table, right? You can see examples of companies that operate in the horizontal space. We already covered some, like Salesforce, and here you can see the difference in terms of how they compare in terms of revenues and profitability metrics, right? So horizontal space companies on the left hand side, and the vertical companies on the right hand side. Okay, and so this is one thing. Another very interesting thing that I stumbled upon is this, and I want to stress this can be very, very good. Okay. So, because what happens is this may very well benefit companies like Constellation Software, because remember, they are a serial acquirer of vertical software companies. So, what does that mean if the market is under a lot of pressure? It means that many of the companies they are acquiring are now trading cheaper relative to historical levels. And so this can bode very well for companies like for the behemoths within the software space. And this is what CNBC is saying right here in this article. Software sell-off sparked by AI set stage for potential big year of M&As, investors say. So I think this can bode very well for companies like Constellation Software. Okay, after all, they grew a lot through acquisitions. Right. Another thing that I want to that I stumbled upon was this Substack by Lucas Summit Stocks. This is a great read on Constellation Software, and look at that. This gain cannot be overstated, right? So look at this. Some of the best performing stocks of the past 2 decades have been serial acquirers. And by the way, now that we are on the topic of serial acquirers, which I can talk about more in a future video, you can see right here that serial acquirers tend to outperform the market over time. Look at this. Okay? Look at this massive outperformance. Look at that. Superior long-term share price performance. Look at this. 20 years, right? Fantastic. 20-year index share price performance. Serial acquires outperform, substantially against the S&P 500, against the MSCI World, and even against Berkshire Hathaway. Staggering. Okay? Fantastic. Now let's go back here. And the serial acquirer of software businesses has been a 210 bagger since its 2006 IPO. What I would say is that this is not accurate because this was written in October 22, right, 2025, and the company has sold off massively since then. So if I go here to Interactive Brokers, you can see that in October 2022, the company was trading at 3,700 Canadian dollars. Okay, so we are substantially lower than that. So this, but the thesis is let me go back here. Sorry, but still, look at that. This gain cannot be overestimated. A 10K investment at the IPO would now be worth about 2.1 million. Okay, that is staggering. And so what I wanted to share right here about this, look at that. He also talks about the research that article that I stumbled upon. Okay. And look, this shows you that. Look, research from Main Capital shows that VMS companies consistently spend less on both R&D and S&M, which means research and development and sales and marketing, compared to horizontal software firms. As a result, VMS, vertical market software businesses, operate more profitably. Okay, pretty cool. We already addressed that. And here you can see some of the differences. But what I wanted to show you, let me show you this. Okay. This is where you start talking about AI. Okay, investors are asking whether it will commoditize the kind of niche industry-specific software that VMS companies have long dominated. The fear is that anyone will soon be able to build their own software using AI, making Constellation's legacy solutions obsolete. Constellation, in a recent investor call, which by the way they arranged solely to address AI concerns, right? They management said that they don't know how AI will affect the industry. I don't really think this is a good thing. Okay, it's not like they said AI is not going to impact us, so they don't know. This is not. I don't think this is what I would like to hear if I were an investor. But at the same time, I understand where he's coming from. He cannot lie because we don't know what AI is going to do going forward. So, and this is some of his words. It's difficult to say whether programming is facing a renaissance or a recession. We don't know which way this is going to go. We are monitoring the situation closely. So far, AI looks more like a productivity enhancer than a disruptor. It helps developers rebuild code faster, but doesn't reduce switching costs. To this author, it seems like replacing a mature, mission-critical VMS product with an AI-first or no-code system would be a financial and especially operational challenge. Okay, this is what I wanted to say. And sure enough, if we look at the fundamentals of the company, right? For example, now that we are on the topic of Constellation Software and why I think the vertical software market is less exposed to this disruption, right? we can look at the best company in the vertical software space, and that is arguably Constellation Software, even though they are more, uh, they are a serial acquirer. But you can see, look at that. Let's go here to revenues. So, and let's put this, let's change this to our quarterly screen. Okay. So you can see that since 2019, revenues have compounded by about 21.62%, which is very good. Now, more recently, though, okay, revenues have come down. So the growth since this is since 2024. Still, you can see that since 2023, the revenues have compounded by about almost 18%. So they are still growing very nicely, okay, very attractively. What about earnings? Let's talk about earnings. In the case of Constellation Software, because they are a serial acquirer, right? There might be some noise here. Okay, so earnings might not be the best metric for us to look at. And sure enough, this is exactly what happens. Look how bumpy earnings are, because you have to understand the business model. They are a serial acquirer. What we can look at, unless they are doing a lot of investing a lot on capex, but you can see, for example, on a yearly basis, you can see that cash flows continue. Look at that. You see, more consistent over time. In fact, in 2024, they were at right now, the trailing 12 months, they are at all-time highs. So the free cash flows continue to compound very attractively at 24% since 2019. And if I go here to 2021 at 18%, I mean, this is staggering. So absolutely fantastic. Let's have a look at their let's have a look at their financials right here, particularly ratios. Excuse me, margins. Right, I want to see their margins to see whether or not they have been under pressure. So let's go here to our metrics. Gross margin. I'm using the trailing 12-month period. Look at that. Margins have been staggeringly consistent, gross margins, but let's check the operating margin, right? Look at that. It was down, it had been trading lower, but now it's resuming back up. So this is very good. Okay, what about net margins? Net margins took a hit recently. Okay, but again, this comes down to the volatile net income that we saw on the income statement. So understand that exactly because they are a serial acquirer. But if I go here to the free cash flow margin, look at that again. Since 2022, they have been going up. So margins overall are improving, which is something that I like to see. And in terms of capital allocation, if I go here to ratios, let's have a look at our capital allocation metrics and see what we have. So let's see. Ratios, I want to check quarterly. Look, okay, so ROI has been coming down, but again, this is because, yeah, it's bumpy, exactly because of the acquisitions that they make. But okay, ROIs, yeah, so since 2021, this thing has been coming down as well. We have to understand why this is happening. Why is ROIs, oh, I already know why this happens. Okay, I understand that. Of course it is. Because they are a serial acquirer, guys. Let me explain what that means. When a company does a lot of acquisitions, they will show a lot of goodwill on the balance sheet. And of course, how do you calculate ROIs? You have to do the net operating profit, right, divided by the invested capital. And if ROIs goes up, the invested capital, which is the denominator, will also go up, and so ROIs will go down. And so what we have to do here, when you calculate the return on invested capital, you have to strip out the goodwill, okay? Because we need to account for all the acquisitions that they make. And sure enough, if I show you guys this right here, look at that. If I go here to cash flow statement, right? So cash flow statement, other investing activities. Look at this. Okay, this when they say other investing activities, this comes down to acquisitions. Okay, and that's why you see those high figures right there, which you can see. Net evaluation, hundreds of different liabilities. Yeah, so yeah, it's this bit right here, other investing activities. Cool. Okay, so I mean, this is it, guys. So no, I don't think not all software companies are created equal, and I don't expect all of them to be disrupted equally as such. But am I going to invest in a company like Constellation Software, which has been a terrific compounder over time? That I don't know yet. I'm still doing more research, and indeed, I intend to create a separate video on Constellation Software, and we will see. I look like Warren Buffett. I always try to stay away from software companies, even though I worked in the space, right? And I know how fast things can change. And so I know that firsthand. And so I don't, at this stage, certainly, I'm not comfortable investing in this company. I would have to do a lot more research to understand my take on it. But as always, I will keep you guys posted. And everyone, if you enjoyed the video again, smash the like button. It really helps the channel. And let's continue to compound both wealth and value over time. Thank you so much, everyone. Stay safe.